Charitable deductions in Section 642C. That's the subject of today's ACTEC Trust and Estate Talk.
Welcome to ACTEC Trust and Estate Talk from the American College of Trust and Estate Counsel, a professional society of peer-elected trust and estate lawyers in the United States and around the globe. This series offers professionals best practice advice, insights, and commentary on subjects that affect our profession and clients. And now, our ACTEC Fellow host with today's topic.
This is Travis Hayes, ACTEC Fellow from Naples, Florida. In light of new rules enacted by the Tax Cuts and Jobs Act in 2017 and final regulations issued on charitable gift substantiation, which followed soon thereafter, taxpayers may discover that their personal donations to charity do not qualify for an income tax deduction. However, just because a charitable contribution fails to qualify for an individual income tax deduction, it's possible that a deduction will not be precluded for purposes of trust and estate income taxes. So what do planners need to understand regarding the requirements for a trust or estate to qualify for an income tax charitable deduction under Section 642C of the Internal Revenue Code? ACTEC Fellow Jerry Doyle from Boston, Massachusetts is here today to make sure we understand the ins and outs of qualifying a distribution to a qualified charity from a trust or estate for the income tax charitable deduction. Welcome, Jerry.
Thank you, Travis. What everybody has to understand is that the income tax rules that apply to individuals and the rules that apply for estate and gift tax charitable deduction are not the same for a fiduciary income tax charitable deduction. So if an estate or a trust wants to get an income tax charitable deduction, they have to follow the requirements of Section 642C of the Code. Under Section 642C of the Code, there are two really important requirements. The first requirement is that the amount that is paid to the charitable organization from the trust of the estate has to be paid from gross income. And the other requirement is that the amount that's paid has got to be paid pursuant to the governing document. So let's take a look at those two requirements. The first requirement is that the amount has to be paid from gross income. What do we mean by gross income? If you look at Section 643B of the Code, you'll discover that what they mean by gross income is taxable income, not trust accounting income. So the amount that has to be paid from the trust of the estate has to be taxable income, which means that you can pay an amount that is capital gain or income irrespective of decedent that normally is allocable to trust accounting income. Because those items are taxable income, those will qualify for an income tax charitable deduction. So the first thing that's important is you have to pay the amount from taxable income. The second requirement is that it's got to be paid pursuant to the governing document. And this is where things get a little confusing and a little messed up. There has to be authority in the governing document, the will of the trust, to direct the payment of that gross income to charity. If you don't have that language in the document, then you don't qualify. So one of the issues is whether or not it is a mandatory payment of gross income. Can you have discretionary payment of income? Yeah, you can. There's an old case, the Old Colony Trust case from back in the early 1900s that said just simply having the discretion to pay the amount to charity, that language in the document will allow you to qualify for an income tax charitable deduction. So those are the two big requirements. And this is completely different from the income tax charitable deduction for an individual, because for an individual, they're limited to a certain percent of their adjusted gross income. Unlike an individual, the 642C deduction is unlimited in an amount. So you're not limited by your percent of adjusted gross income like it is for an individual. And furthermore, if you don't meet these requirements, there's no fallback provision in claiming an income tax distribution deduction, an income distribution deduction for a trust or estate. You either qualify under the requirements of Section 642C, or if you don't, you can't take an income distribution deduction. Unlike individuals, what will happen is the amount that is allowable for a charitable deduction can either be paid in the current year, you pay the amount this year and you take an income tax charitable deduction, or alternatively, you could pay the amount next year and claim it for this year. So you've got a 2-year window period where you can claim an income tax charitable deduction. Also, unlike individuals, the 642C deduction is allowed for a distribution to a foreign charity. Individuals generally speaking, can only get a charitable deduction for distribution to a domestic charity. One of the other things that people have to realize about the Section 642C deduction is that the deduction is basically allowed for an amount that is set aside for an estate. So an estate can get a deduction if they simply set aside the amount for charity. They don't actually have to pay it. And there is also an exception for some trusts that were executed before 1969. They can also get a set-aside deduction. But as a general rule, a trust, as opposed to an estate, has to actually pay the amount to charity. The other issue that crops up that is different from an individual income tax charitable deduction is the fact that the code says you only have to pay the amount to charity for a purpose that is set forth in Section 170C. You don't have to actually have a public charity, so to speak. I wouldn't recommend that people set it aside for a purpose. They ought to actually pay it up to charity, to a public charity. But those are the requirements. The bigger requirements, like I said, paid from gross income, and it's got to be paid pursuant to the governing document. And where we see most of the mistakes made is where there is no authority in the document to take an income tax charitable deduction. So that is an important drafting consideration. Putting in documents the fact that if you want to get an income tax charitable deduction, there's authority in the document to actually pay that amount to charity. That's basically a quick summary of a very complicated section of the Internal Revenue Code.
Thank you, Jerry, for educating us on the operation of Section 642C and the requirements for a trust or estate to qualify for the charitable income tax deduction.
Thank you for listening to this episode of ACTEC Trust and Estate Talk, the podcast series about wealth planning matters from the American College of Trust and Estate Counsel. To find an ACTEC lawyer near you, visit actec.org. Please subscribe to this series and leave us a rating or a review.